Earlier this week, Apple CEO Tim Cook took the stage at an event in Cupertino, California, to unveil the iPhone 11. Here to help us sift through the headlines of Apple's event is Tim Beyers, media and entertainment analyst for the Motley Fool. He joins me now from Colorado. Tim, thanks for being here.
Thanks, Chris.
What is your headline for the Apple event?
It's on like Donkey Kong because we've got games, like for real. So this is very much a services announcement wrapped around an iPhone upgrade and some new watches.
Let me put a pin in the games for a second, because I do want to talk about the iPhone first, because part of what's getting people's attention here is the pricing.
Yes.
Pricing both for the video service, which we'll talk about in a minute, but also for the iPhone 11, which starts at $700. On the surface, this seems like a pretty compelling offer compared to in years past, certainly the past couple of years, where Apple has unveiled the new phone, whatever it is at the time, and it's usually got a price tag of around $1,000.
Right.
Did you see enough with the iPhone 11 to make you think, oh, this is a compelling argument for someone who's looking to upgrade?
It's a compelling argument if you are looking to upgrade but not go all the way up the stack, because this is really epic rebranding, and Business Insider gets some credit for this. They did a review, and what they found is that the iPhone XR, last year's big phone, is roughly the same as the low end of the iPhone 11. So now you're not getting a rebranded low end of the phone. It's just all iPhone 11. It depends on how high you go up the stack, all the way up to the iPhone 11 Pro. And, so that $700 price point looks very attractive, but really what you're getting is an incrementally upgraded iPhone XR. I think that's interesting. I think it's smart marketing. I don't think that it is a compelling value proposition necessarily. Now, what's very interesting to me is the iPhone Pro is a recognition that there are some photographers now who are making a living using their phone as their primary camera, or at least the one that they are using to get out and get shots on the scene. And it does a really excellent job. And so I do think there is a professional market for an iPhone camera. And I think Apple is pricing in that area. They're certainly delivering in terms of features with the multi-lens camera, but I think that is, the outlier announcement here. Really, the big announcement is, can the iPhone 11 at the base level drive enough demand to stop the bleeding? Because this is a business, the iPhone business, that's been growing a lot more slowly in recent years. So we want to really see this turn around. I'd be looking to see how many of those $700 iPhones we're lining up for. My expectation is not really that many, but I do expect there to be outsized demand, at least in that niche that needs it, for the iPhone 11 Pro.
So we saw this a few years ago in the enterprise space, where computers, desktop and laptop, were improving over time. And so you had large companies that were essentially not hitting the refresh button, and they were extending the lifetime of the equipment that they had in their offices. We're seeing this now a little bit with smartphones, where the average consumer keeps their smartphone for about 3 years. I've had mine even longer than that. If you're an Apple shareholder, or you're thinking about buying shares of Apple, do you need to lower your expectations for what iPhone is going to do to the bottom line?
I do think you have to. And I'm right there with you, Chris. I mean, I've had my tiny little iPhone SE for coming up on 3 years now, and I'm not going to upgrade. So I do think we're in this phase now where the smartphone refresh cycle is extending. And that's part of the natural evolution of technology. The better the technology gets, the better the underlying gear gets, the more sturdy it gets. It has a longer life. And so there's less temptation to upgrade. And on top of that, you have cloud services that you can get anywhere, apps that you can get anywhere. So it's much easier to upgrade the phone without upgrading the hardware. And this is Apple sort of killing itself in a way, because the services business is growing fast. It is the second biggest part of Apple in terms of overall revenue. And so by making its services business so attractive, it does in a weird way make the the business of upgrading your iPhone, it's just a little easier to put it off now. So yes, I do think we're seeing that. Now, if you're going to become an Apple shareholder, to answer the second half of your question, what you really should be focused on is what Apple can do with its balance sheet and in this services business. Because certainly one of the things that people are going to be looking at is the wearables business. And I know we're going to get to that. That is a potential catalyst. But the future of this company is going after Netflix, going after Amazon, going after Nintendo, going after all content and trying to own all of it through every device that they sell. So it becomes like content at the center, and we happen to sell devices around it. That's an interesting strategy. If you believe that Apple can own that and disrupt Netflix and Amazon and others, then it's a compelling buy here.
So Apple TV Plus, their video streaming business, they came out with a price tag, $4.99 a month. Are you surprised? Are you surprised they went that low?
I am very surprised they went that low. I mean, that's a gut punch, man. I think Netflix and Disney took a hit after that announcement, the stocks of both those companies, because that's a gut punch. I mean, basically, Apple is saying we're going to run our content business at a loss in the short term because we are intent on grabbing market share, because this is not new. Apple has been in the content business for a little while, and their content hasn't really caught hold. So now, by lowering prices so dramatically, Apple is saying, look, give us a try. You're going to like what you see, because the content is not selling itself right now. So they're looking for the price to sell the content until the content can sell itself. So I'm very surprised. It's a bold move, and it may pay off, but not in the immediate term. This is much more of a long-term play where Apple is using its balance sheet, that $100 billion in cash that they have available, to make a power play in both the gaming business and the TV business.
Well, and they also got a tiny bit of a leg up on Disney with the timing of when Apple TV Plus comes out, because it's coming out November 1st, nearly 2 weeks ahead of Disney Plus.
Right. And that is important too. So there's definitely going to be a rush to figure out, especially going into the holiday season, do I want the Apple TV? Am I going to buy, a new Amazon device? Am I going to order Disney Plus? This is going to be a really interesting holiday season. And in the middle of all this, right, is Netflix. And so now we get to see just how sturdy the Netflix model is, because up to this point, Netflix has had two principal advantages. The first is that they had scale. They have a lot of scale in terms of a lot of shows, a lot of inventory. The second advantage they had is they're beloved by artists and creators, because they give you a budget up front and you create and you dictate terms. And artists have been willing to give up things like royalties and residuals in order to work with Netflix. Will that continue to be the case when Apple is throwing money at the business? If Disney is throwing money at this business, we'll see. I think it's going to be a very interesting time for all three of these companies, but the one that's most at risk is Netflix.
Let's talk about wearables for a second, because one of the things I was thinking as I was looking at coverage of this event and also some of the highlights is that it really seems like Apple is positioning the watch as a health device. They had this video of people who were warned of heart attacks by the watch, and it's
right.
I'm not someone who wears a watch, but they made a pretty compelling, almost emotional case for buying this device.
And that is Apple at its best, because Apple at its best makes emotional appeals and connects emotions to technology so that you feel invested. And so it's interesting. I don't know if it's certainly a good short-term strategy to connect the dots and say, hey, look, this is what you need in the environment we're in now. People are working longer hours. We're working out. We're trying to measure our fitness, measure, our lifespans and everything else. The watch is sort of the hub for health tracking, and it's an interesting play. But I think it's also bigger than that. Like if that is the the lone pitch that Apple makes to the Apple Watch, I think that dies in 6 months because we've heard this before. And before, our health tracking device has been our smartphone. So are we really going to take the leap from where we are using our smartphone to kind of track our health with apps like Strava, or even just the built-in app inside, the iPhone or any other smartphone you pick, and moving it to the watch? I don't necessarily think, despite the emotional appeals, that translates over the long term. But in the short term, yeah, it's an interesting pitch.
Tim, this event reminded me, without Apple ever talking about it on stage, and there's no reason that they would, of just how much of an asset their cash balance is. Because if you think back to the initial launch of the watch, it was sort of a ho-hum response from Wall Street. The talk of video programming for a long time has been just that talk, or to the extent that they've executed against that, it hasn't been that inspiring. Right. And this has just been a nice reminder that one of the things that cash enables you to do is it buys you time. We have now new iterations of the watch, and now they're in a position where they can throw enough money at video programming. As you said, we're going to operate this at a loss. We're going to give stars in the industry the bandwidth to create great programming, and we can do that because we got the cash.
That's absolutely right. And let me give you a stat here, Chris. So Apple has about $100 billion on its balance sheet in cash, right around 95 billion. They also have about little under 110 billion in debt. What you don't see, unless you look at the balance sheet, is there's another 100 billion in long-term investments. So Apple has a lot more cash that they could either repatriate from other countries or from other businesses and put to work. They have a huge runway. And Apple has gone from being a company that's keeping cash as a cushion to now being a company that's using cash as a weapon. That's different. So this is a very different look for Apple, and it could bring in a new era for this company and drive returns for a while, but it does remain to be seen. It's just a fundamentally different pitch. Apple has always pitched itself as, we build something that is high quality, that has emotional resonance, that you're going to want to associate with. They've never been able to get over that hump in entertainment. Now the sales pitch is different, saying, look, this is cheap. If you give it a try, I know we can convince you that the stuff we've got is high quality and has emotional resonance. But they haven't been able to make their core sales pitch in this entertainment business, so they're trying something different, and they're using cash to do it. So it's a very interesting time to be an Apple shareholder if you have shares now. And if you don't, it's an interesting time to look at the business because they're going to be very aggressive. That's one of the main takeaways I got from this event, Chris, is that this is a sharper elbowed Apple that is taking fewer prisoners than it used to.
Last thing, and then I'll let you get back to work. Shares of Apple are up around 40% year to date. What is something you're going to be watching in Apple's business going forward?
I'm going to be watching the services line item because it's growing. It's growing quickly. It's not growing as fast as wearables, but I want to see what the uptake is. And I want to see not only the growth on the top line, but what does the operating margin look like? Because if I'm right, and this is running at a loss, we're going to start to see some thinning margins inside that services business. That's okay, as long as the top line is growing very quickly. So I'm looking for maybe some acceleration in terms of revenue from the services business, while the operating income, where a lot of the expenses, some of the fallout from running this at a loss, is going to show up. If those two things start to normalize and get bigger, I'll be very, very interested to see that. And if it moves faster than I expect, then two things I expect will happen. First, the stock will respond accordingly, and it might be a dark day for Netflix.